sometime after I started 100X.VC, I read it in the newspaper that it got acquired by another large company. They got acquired again, second time. And I was like, how did this happen, right? And then that's when I realized that, the lesson in that was that, sometimes founders are not building only to sell. Sometimes founders are building a technology. Maybe a large company can acquire it. And there's nothing wrong in that, because, if there is a technology which can be built, which has a use case, which can accelerate a larger company's vision also, there's nothing wrong. So, so that was my learning from it. Those guys have now started their third company. I'm not sure whether they're going to sell it again or continue building it.
क्या आप भी स्टार्टअप्स के बारे में जानना पसंद करते हैं या फिर आप अपने स्टार्टअप के लिए फंडिंग चाहते हैं? Stay tuned for today's session. Hello folks, welcome to the series named Interaction with Investors, where we help people to learn from their very rich experiences. Today, we have a very special guest amongst us whose name is Shashank Randev. He is the founder, VC and co-founder of 100X.VC, a venture capital firm. He was also the founding member and vice president of VCCEdge, a SaaS data platform by VC Circle. He is also an angel investor in companies like BlueLearn, Knorish, Renal Project, etc., with very rich industry experience. Thank you so much, Shashank, for accepting our invitation and coming up to the show.
Thank you, Madhur, for inviting me, and I'm very excited to be here and looking forward to our conversation.
Before we proceed, do like and share this video. Also, don't forget to subscribe the channel for more such videos. Let's deep dive into your journey, Shashank. Can you tell about your company 100X.VC and how is it different from other venture capital firms?
Sure, Madhur. So we are, we started a journey in 2019, July of 2019. And our objective was and continues to be the first check into portfolio companies or very early stage companies, right? And giving them the ability to raise capital soon. So the only difference between us and the other funds is that we do investments through iSafe notes, while others do through a shareholders agreement, which is applicable at later stages when the companies grow. But we want to invest in ideas which are just starting out from colleges. We've backed many student-based companies and also first-time entrepreneurs who are just starting their journey, right? And this fund is made in such a format that we can support the journey of early entrepreneurs. So that's the only difference, and we are doing a very large set of companies. So we are already at 80 portfolio investments, and we are now about to cross 100 with our class 08. We initially used to invest 25 lakhs INR, and now we've increased the check size for each company. That is 1.25 crores per company. So going forward, every company from our side will receive 1.25 crores. So that's a quick thesis about, overview about 100X. We're an early stage fund investing in very early stage companies across India, tier 1, tier 2, tier 3. And our check sizes are standard now, 1.25 crores as opposed to 25 lakhs, with what we started. And we've done 80 investments, and we want to do 100 investments a year. So we want to back as many college entrepreneurs, engineering, arts, commerce. If they're building up businesses, we want to be there, because 10% of our portfolio companies are companies which were started in colleges, and we funded them right after college.
Yes, that's really an interesting initiative to start or to invest in companies at a very early stage and help them to grow their idea and products. Why 100X.VC uses iSafe notes instead of CCPS or equity funding, which is more common?
Sure. So iSafe is actually a condensed version of CCPS, or compulsory convertible preference shares. The reason why we do this, as I mentioned in my first answer, is that we want to be the first institutional check, and we want to invest in companies where founders are just starting their journey, right? There is no inherent value assigned to the company till the time they don't build something, right? And we want to support that journey. Now, a typical shareholder's value requires you to value a company, right? And that is a function of how you've grown or progressed, and how your journey has been for a value to be assigned. And we are coming much before that to support your dream, right? And hence, iSafe enables founders to raise capital from 100X.VC without assigning a valuation. So you 1.25 crores, if you get shortlisted by 100X, you receive today for a future equity, which means that whenever you raise the next round, which is your shareholders round, is when you have to give equity to 100X, right? And that is the beauty of iSafe. It enables closing or raising money within 2 to 3 weeks, right? So that gives Indian entrepreneurs, founders, a great window to receive money, to start building something and to deliver something more tangible in the coming days or months or quarters, right? And hence we decided that in India, we wanted to build out a fund which could support at the bottom of the pyramid, and kind of, give capital quickly without too much of legal cost. And it's an open source document, iSafe agreement, which is on our website. Even if people are not raising from 100X, they can go ahead and use that instrument to raise capital from friends and family.
That's a really nice idea, to invest into the future equity of the company and help the founders to build their idea, and also to give them very quick funding. So what is your biggest learning being an angel investor in so many companies?
Well, I mean, actually, my angel portfolio is not that big right now. It's a fairly small number in my personal investments. But, obviously, I've been part of the ecosystem, when I started VC Circle, it's a VCCEdge. And from there on, that company getting acquired, I saw the startup getting acquired. And then I started my angel investment journey in May of 2018. But my other partners, at 100X.VC's Sanjay, who's been a very active angel investor, 150 plus, and he's seen, more than 4 or 5 unicorns. So seeing him, seeing my bunch of portfolio companies, and then obviously 100X, right? We've got 80 plus portfolio companies. I think one common learning out of this is that, I think raising initial capital when you're starting a journey is important. And I think, but what is also important is getting the like-minded angels, advisors, mentors who come on board, right? So early stage companies require a lot of support. And sometimes, if you open a door to some company for them to get business, those kind of steps take them a very, very long way, right? And so some of the key learnings is that, it's you invest on hope, you're investing in founders, and the business model will keep pivoting. But if you really, really believe in the founder, then you should go ahead and invest and stay put, even if things are going a little down, because that's the momentum of the ecosystem or economy. But if the founders are the right founders who have the mindset to build, then they will build anything into something which is scalable, right? So one lesson is that backing founders first is more important for me as an angel investor than only looking at the market or only looking at the business model.
So how would you check if the entrepreneur has the right vision and team for their startup idea?
It's not always easy, right? But there are 2-3 indicators which you can say. For instance, I mentioned that we invest in student-based companies, right? Or rather, students starting out in 3rd year, 4th year, right? So we've invested in companies, but there we took our own time to analyze. And what were those parameters on, right? Are the founders doing this as a side project in college? For a internship or something like that, or is this something they really want to build out, right? And this is the case in BlueLearn, which is a portfolio company. Bits Pilani kids, great founders. We started looking at them when they were in third year, eventually invested in them when they were in fourth year. By fourth year, we were confident that they're actually building something out, and they don't want to go for placements or anything. They really want to build this out. They already had enough traction, which was in the form of a large community and creating stickiness for the students to come onto the platform. And so one of the things which we look out for is, are the founders full-time, right? Are the founders giving their best? And they should not be moonlighting. They should not be doing it part-time, because that's something which doesn't work. Then the most important thing is, are they going after a market which is unique, right? Is it really going to be big enough? So the market size opportunity. There are various ways of determining that. There is no easy answer. Some of the markets are not built, for instance, they will be built after 4 or 5 years, but you start building a product or a vision for something which might come later. So that is what VC business is all about, right? For third is business model, right? Is the business scalable? And these are some of the traits which we look for when we are investing in entrepreneurs. But I think largely we're looking at their ability to be full-time, frugal, not having a mindset of splurging money, right? Funding mil gaya or bahut bada office le liya and all that. That mindset is very important, right? And also somehow analyzing the mind that if for lack of better word, if the shit hits the roof, will they pull up their sleeves and not get depressed, but make something out of it, right? So that is the kind of attitude which is very important, obviously with the practical mindset to build a scalable business, right? And these are some of the things which we look for. Obviously we learn as much as we can from the founders, because they're constantly teaching us, they're telling us about this new market, right? So it's a mix and match of a lot of things, but at the end of the day, it's a lot more human interaction and human trust which needs to be established in the beginning before we invest in the founder, more so than numbers or financials or so on and so forth.
So what are some of the most common mistakes an entrepreneur does while pitching it to a VC?
I think one of the biggest mistakes founders do is, and there are a bunch of things. One is obviously their inability to communicate their ideas simply, right? They might have built the next sophisticated mouse-sized device which can provide electricity as compared to a nuclear power plant. But if it doesn't convert into a business, then it doesn't mean anything for investors, right? So their inability to talk about their technology in a business format is a challenge which we see in founders. The other thing which we see is some of the founders want to draw a salary as opposed to creating wealth, right? And wealth creation is a mindset which needs to be had, which needs to be inculcated in founders. They already own equity in a company, right? Then their responsibility is to increase the value of that company and not focus on drawing salary, right? Because if the value of the shares increases, their value increases, the company's value increases, right? And sometimes we see that founders are only looking to raise money because they want fund, they want some salary to be taken, right? So, and that mindset doesn't work. And then obviously, just ensuring that they make mistakes in terms of not being able to kind of build the right product, right? Because they sometimes end up building a product where a couple of friends met and they said, Chalo, let's start this, but there is no market for it. The product has no customers, no use, right? So I think one more reason why founders need to focus before they launch is, how big is the market? Where is your customer client? And how big is the base going to be over the next 5 years, as an example, right? So these are some of the mistakes. Obviously there's plethora, but these are some of the mistakes which founders make on a regular basis.
Yes, that's a really nice perspective that you shared, and it would help a lot of the entrepreneurs to avoid making these mistakes during their own journey, as well as pitching it to a VC. How can an undergraduate student enter into VC space for either jobs or internships?
No, I think they should. Every VC firm is now available online, like any other thing which is available online, right? So for the first time, students in 2022 are much better off than students in 2002. When that is when I was in my third year of engineering, FYI, right? So people are more approachable. You've got LinkedIn, you can reach them. The websites are there. And we ourselves run a 6-month internship program only to hire from colleges, right? 6 months full-time internship with us doesn't convert into an employment, but gives you insights into how VCs work, right? And every VC wants interns right now, and they hire a lot. So it's as simple as going on to LinkedIn or going to their website and just checking if they have an internship running. And at any given point of time, there are at least 2 or 3 active internships in a week, which is open, right? So I don't think so that's a challenge anymore.
How one can improve the understanding of Indian startup ecosystem?
I think everything is now more or less open. But one of the things which you can improve, build upon to improve your understanding of the ecosystem is, I think, one is obviously subscribing to newsletters, right? Which are your stories, tech circles of the world, which gives you insights into what type of companies are getting funded. The other is obviously reading reports, right, on the Indian ecosystem. There are many global companies like McKinsey, BCG, but there are many Indian companies like Traxon, and they come up with reports on specific sectors, right? So if you are a founder and you want to understand and you want to build something in agri-tech, so you download reports in terms of what is happening in agri-tech, and there are specific reports on agri-tech, right? And this is how you can develop your there's just so much happening in the whole startup ecosystem right now, and you should get an understanding of what kind of information, what kind of reports or repositories are tracking specific sectors, and get a sense of what are the challenges which are being faced there. Now, for instance, in India, UPI has just leveled the playing field for everyone, right? Such a great initiative by the government, right? Has just suddenly, I mean, you're sitting in Ladakh and you have an aunt who's stuck in a traffic jam and doesn't have cash. In Kanyakumari, you can just UPI it to her, right? It's just becomes such a simplistic, transactional and seamless experience. So like that, one way of understanding the Indian startup ecosystem is how, like UPI, which has just removed the friction, what are the other friction points in India in sectors? Agri-tech, health tech, food tech, B2B enterprise tech, deep tech, clean technology, right? And then what are the other companies who are building solutions or not building it, right? And that is one way you'll get an understanding of the whole Indian startup ecosystem, where we are at. And if you're a founder who wants to build something, will also give you enough material, research material to kind of, okay, I know this is not there, and I believe this is a good market, and let me go ahead and build it. So that's my 2 cents on that.
Yes, that's a very nice way that you share to improve our understanding of Indian startup ecosystem, especially by reading various kinds of reports and by finding the pain points that are present in various sectors and seeing things related to that, like how they can be improved or resolved. What are your thoughts on the upcoming sectors, like in deep tech, like gaming, Web3, space tech, drone tech, etc.?
No, I think we are a sector agnostic fund, Madhur, and we've done investments in all these sectors. And I feel every sector is a great opportunity for India right now. There is opportunity in drone tech. There's opportunity in clean tech. We invested in a company called Mo Energy, which is helping you increase the battery life of electric vehicle batteries, right? Huge opportunity in India. We've also invested in Jetson Robotics, which is a solar panel cleaning robot, which doesn't require human beings or water in large quantities to clean, right? And then you've got, we've invested in fintech companies and then bunch of deep tech companies. So we are particularly at 100X, we are very excited about the sectors which are emerging, all of them. And I think the way India has the digital penetration across tier 1, tier 2, tier 3, and possibly tier 4 also now. There is every sector from agri-tech, from rural India, Bharat, to the urban Indian population, consumer offerings. Every sector in India is an opportunity for us, and hence we are a sector agnostic fund. Web3, in my opinion, has many tenets. It should not be linked only to cryptos. It is based on multiple other things, augmented reality to infrastructure play, and I think Web3 is definitely going to have a very large impact. And we ourselves at 100X.VC are particularly focused over the last few months in evaluating very, very interesting opportunities in Web3. And Web3 is going to emerge quite effectively. And deep technology, deep tech, we've already done 11 investments so far in the last 3 years in deep tech. So we are firm believers of deep technology startups emerging out of India. We've seen deep technology companies come up in fintech, all the way to media tech, which are converting videos into 52 languages. A company called Vitra.ai, and bunch of other companies, right? So huge opportunity. And I think, Madhur, to all your audience, India offers great opportunity for any sector to build out, because the market is ready here for it to consume also. As I said, I come back to my previous point. There are a lot of friction here. If you're able to figure out which friction you can address and remove that, there's an opportunity.
What is your biggest venture investing mistake and what did you learn from it?
So I've written an article on this. It's on my anti portfolio in Live Mint. For the audience, everybody can go online and check for the same. Also go to my LinkedIn profile. I'm sure I've mentioned it over there as well. So so my learning from this was almost a year before I started 100X.VC along with my other partners. I was evaluating a company and I was advocating for it. As in an angel network. So in angel networks, what happens is one person who likes the company leads the company and says, everybody, okay, fine, I lead it in terms of, telling you why it's good and you guys can combine and all that. So I really believe this one company, the ex-IIT guys, good pedigree, but they weren't, and they'd already sold one company to a very large company, and now they're working on second company. So I was like, this is a great team and the opportunity seemed nice. 6 months passed by and they built out the product, and I told them, why aren't you selling? And we connected into 2 clients and they didn't sell. They weren't selling, and I lost confidence in their capability, right? So I pulled out and I said, I'm not going to lead this because I'm asking everybody else to kind of come on board and invest in this company. Well, now I'm losing conviction because I'm not seeing progress. And I decided not to lead it. And I think sometime after I started 100X.VC, I read it in the newspaper that it got acquired by another large company. They got acquired again, second time. And I was like, how did this happen, right? And then that's when I realized that, the lesson in that was that, sometimes founders are not building only to sell. Sometimes founders are building a technology. Maybe a large company can acquire it, and there's nothing wrong in that, because if there is a technology which can be built, which has a use case which can accelerate a larger company's vision also, there's nothing wrong. So so that was my learning from it. Those guys have now started their third company. I'm not sure whether they're going to sell it again or continue building it, But yeah, I think that was my learning from that particular company.
That's a very interesting learning that you shared. How important do you think is to have a past entrepreneurial experience to become a good VC?
Yeah, I think it helps. It certainly helps. What happens is that the VC industry and the startup industry are very similar, right? There is no verticalizations. It's very horizontal, open. Anything can come in. It's like driving a car on Indian roads. Anything can come from anywhere, right? So it's your ability to maneuver, right? And I think that is what I see. There's a use case, right? We can do so much in traffic also. So there's a startup friction problem which can be solved in India for that as well. But so if you've built a startup, so operations of running a startup, I think that teaches you a lot. And there are many VCs who've been operators. And what do you mean by operators? Is that they've either run a company beforehand. So if you worked in a startup and if you've built a startup, you're definitely cut out for the VC industry for sure, because you understand the landscape, you understand the challenges. You'll be able to evaluate businesses because you've been on the other side. If you have been a CEO or a top guy at a very large corporate, yes, you can be an excellent VC because you have a mindset of how you're running. But let's say you're a programmer and you're a manager with only 3 years of experience who's just joined a large corporation, then the probability of you becoming a VC is then, because there's no practical insight, right? You're driving a bicycle, you're not on the traffic road, right? So the similarities end over there. So hence, if you start a startup and if you've been associated with a startup, because the culture is very vivid, the hierarchy is very horizontal, everybody is expected to do everything. A program manager, a programming or a coder guy is expected to do marketing also, right? Any and everything goes on in a startup, right? So it really teaches you to manage multiple things at a time. Similarly, very similar to what VCs do, managing portfolio day in and day out from different sectors. So to answer your question, yes, if you've come from a startup background, that really gives you an advantage to become a VC.
In presence of so many big monopolies like FAANG, Tata, Reliance, Adani, etc., do you think is it possible for any startup to become one of the biggest companies in the world in upcoming years?
Of course. I mean, look at the examples which have already emerged, right? Paytm, built out from India, Razorpay, built out of India, Bharat Pay, built out of India, right? You've got InMobi, Flipkart, which got built, acquired, such a big company, and many others, right? This is just the second phase of evolution for us. So you will see a lot of companies emerging, starting up, which will actually there was this one healthcare company, I'm forgetting, which actually acquired a very large legacy old Path Labs business, just a 4-year-old startup. So those things have already started happening, right? So I think it was PharmEasy, if I'm not mistaken. And those things are going to happen right now. We will see, because you have to understand, Madhur, that you guys are 90% of the population of India in the age group of 18 to 27. You are going to be the highest consumers. If you and your generation believe that this is the way something should be consumed, like our generation, when we had to stand in the bank lines because our fathers used to send us to deposit a check, your generation refuses to do that. You will not do that. You will try and build solutions around that. Similarly, giving the same analogy, your generation will find out ways and methods to kind of figure out to remove the friction out of the Indian ecosystem, right? And hence, we will see a lot many companies coming in, building out businesses which are very scalable, which are, if not exceed but compete with the largest corporations in India. For sure, certainly.
Does deep focused investing works in VC space instead of the common well-diversified strategy?
Well, it depends on which kind of stage you are at, right? There are actually deep focused, sector focused funds. There are funds which are only doing fintech investments across stages, seed to series D. There are companies which are only doing SaaS and deep tech, seed to series D, F, right? So yes, sector focus really makes a lot of difference. It really depends on the fund manager and their mindset, right? Some funds like us want to be at the bottom of the pyramid and support every entrepreneur across sector so that they get funded and go to Series A. And some funds who have experience in fintech only, as an example, they'll say, okay, fine, we'll come in at, let's say after 100X, if all their fintech portfolio, we will like to value it, and then keep funding that company if they keep growing, and do multiple stages of the fintech. Similarly, SaaS, clean tech, right? So there are sector specific and sector agnostic funds. Each has to be there. Each is important in its own category because each comes in at a stage, and determining the stage, it fulfills the need for the founder, right? And that is what is most important. So both are equally important, sector agnostic as well as deep focus.
Any last message that you would like to give to all our viewers who wanted to make a career into venture capital space?
So I would say, building a career at venture capital, the best way is if you've built out a business, right? So if you're building out a startup mindset, then my suggestion is go get your hands dirty in a startup to really enjoy the venture capital mindset, right? You will be able to evaluate and appreciate businesses much better. So my first advice is, instead of picking up internship in VCs, go pick up internship in startups, right? Learn the grit and the dirty work which goes on, right? From cleaning utensils to switching on the lights, pulling down a shutter, to working 2 a.m. in the night, figuring out a code, all of that, fundraising, all of that, right? And that, I think, is a great opportunity for students, in third, fourth year colleges, moving out before they pick up, real jobs and full-time jobs right after their graduation. That's my first advice to them. Second advice is, I think it's a great time in 2022. I think the next decade is very, very interesting for India. And I think all of us should be working in terms of, addressing the key challenges, because large businesses can be built out, right? So if you are thinking of building out businesses or starting your journey, it's a great time because we've got capital to give, and if the idea is scalable and the idea has potential to grow, then there's a huge opportunity for both the founders and the investors to join hands.
That's a really nice perspective that you shared. Thank you so much, Shashank, for taking out your time to share your learnings and experiences. It would be really helpful to a lot of the people. Thank you.
Thank you, Madhur. Thank you so much. Thank you for having me.